The world tells you that wealth is loud, that the path to financial freedom is a neon-lit highway of hustle, endless posts, flashy cars, and constant announcements. Yet you feel a quiet anxiety gnawing at the edges of your life, a subtle awareness that something isn't working. You've followed the formulas: save a little, invest a little, work harder. Still, the numbers barely move. The problem is not your effort. It's the invisible architecture you've never been shown. This is the trap. The systems that create real, compounding income streams are invisible, and they are structured to reward patience, subtlety, and strategy, not noise. Consider your body for a moment. It does not scream when it grows muscle. It does not announce every cellular repair or hormonal adjustment. Yet beneath the surface, the quiet processes are shaping its future strength. Financial growth works the same way. Most people look for instant indicators, Instagram posts, headlines, flashy deals, but miss the quiet engines that, over time, generate relentless power. Those who understand these engines don't have to hustle publicly. They don't need approval or recognition. They build quietly, systematically, invisibly. And this is why most people never escape. They chase the visible signs, while the invisible structure silently dictates outcomes. There is a physics to money, a kind of gravitational pull that organizes wealth in a way few see. Imagine capital like water in a landscape. If you pour it on flat ground, it disperses, evaporates, leaves nothing behind. But if you channel it, through hidden canals, subterranean aquifers, unseen reservoirs, it accumulates, feeds itself, and eventually overflows in abundance. Most people pour their resources randomly, chasing the latest hype or mimicking others, and are left frustrated. Only those who understand the hidden terrain can create streams that grow quietly, powerfully, and without attention. Here's another truth. Few speak aloud. Money has memory. Not in the sense of accounts or statements, but in the way past decisions compound into future power. The choices you make now, often invisible to those around you, will dictate the size of your future income streams. Yet, because humans are wired to seek instant gratification, we sabotage these structures before they can even take root. One impulsive purchase, one emotional response to status, one unquestioned assumption, each can ripple across years of compounding potential. The secret most gurus never share is that growth is never loud. It is quiet. It is strategic. It is structural. It thrives in environments of control, patience, and subtle leverage. And most importantly, it is invisible. The systems that allow money to reproduce quietly are not advertised. They are learned, studied, and mastered. Once you see them, you begin to notice patterns everywhere. How capital flows, how decisions amplify or decay over time, how identity and psychology shape financial outcomes without your conscious awareness. But there is a deeper layer, one that changes everything. You're not just a participant in these systems. You're the architect. You can design the pathways that will capture and multiply income in ways the world never suspects. Yet few ever make this shift because it requires abandoning what feels safe, the visible, social, and culturally validated markers of success. To step into this system is to embrace a paradox. The quieter you grow, the greater your eventual power. Imagine 3 income streams, each growing quietly, independently, and compounding. One is the product of skill leveraged in an invisible niche. One is the product of capital allocated strategically over time. And one is the product of opportunity recognized in silence before it becomes obvious to everyone else. Each operates under different laws, yet all converge to create an acceleration in wealth that looks sudden to outsiders. But to you, it is the natural consequence of quiet, deliberate design. This is where the structure reveals itself. And this is where most people never arrive. They look for hacks, shortcuts, or social validation. They measure success in noise. But you, if you continue reading, will be introduced to the invisible engines. You will see the psychological, behavioral, and structural patterns that allow income to grow without attention. You will learn why quiet systems always outperform loud displays, why patience beats hype, and why the truly wealthy often appear calm, almost invisible, while their capital quietly compounds around them. The question is no longer whether growth is possible. The question is whether you are willing to operate in a world most ignore, where every decision, every allocation, every subtle behavioral adjustment is intentionally designed to feed silent income streams. Because once you understand this, you begin to see everything differently. Every financial decision, every moment of patience, every act of restraint is no longer just a choice. It is an investment in a system few will ever access. And there is one more secret, a final piece that changes the entire equation. But it will not be revealed yet. That secret is what makes quiet growth not just possible, but inevitable. It is hidden in plain sight, woven into the mechanics of money, psychology, and compounding. And it will surface in the chapters to come, layer by layer. Until then, you're at the edge of understanding, peering into a world where income streams do not scream for attention, they quietly become unstoppable. This changes everything. The first thing to understand is this: financial outcomes are not purely the result of effort, luck, or intelligence. So they are the emergent property of invisible systems operating beneath the surface. You have been conditioned to focus on the visible: your paycheck, your bank balance, your spending habits, your promotions. Yet the real architecture of income growth is hidden. It functions like an ecosystem. Each component, capital, behavior, timing, and leverage, interacts silently, producing results over time. You cannot see it in real time, and that's why most people misinterpret progress. They assume that if they can't see the growth, it isn't happening. This is the first illusion we must dismantle. Imagine a forest. To the casual observer, it is simply trees, soil, and light. But beneath the ground is a vast network of roots, fungi, and microbial systems, exchanging nutrients, storing energy, and ensuring resilience. Yes, without this hidden infrastructure, the forest cannot survive. Financial growth works the same way. Your visible money, the balance in your account, is the canopy. It is what people notice. But beneath the surface lies the root system, the strategies, habits, allocation mechanisms, and psychological frameworks that feed it. Most people pour energy into the canopy, buying visible assets, chasing promotions, or accumulating flashy possessions, but neglect the roots. That is why their growth is slow, fragile, and easily reversed. Now, let's remove the shame that often comes with this realization. If you feel behind, anxious, or frustrated about your finances, understand this: it is not a personal failure. It is the structural reality of the system you've been placed in. Educational systems, cultural norms, media narratives, and social pressure all reinforce short-term thinking and visibility over strategic, quiet accumulation. The moment you recognize that the system is stacked against instant visible results, shame dissolves. You see yourself not as inadequate, but as someone who has simply been operating under incomplete information. This is where the first cognitive shift occurs. You stop measuring progress by what is visible and start assessing the health of the invisible system. Are your financial roots strong? Are they diversified, self-sustaining, and resilient against shocks? Here, patience is not a moral choice. It is strategic. Every small, seemingly insignificant decision compounds into structural strength. This is why people who appear to do nothing are often quietly building enormous capacity. The subtle act of directing attention, capital, and behavior into the underlying architecture is far more powerful than any flashy action. Let's make this concrete. Imagine two individuals, A and B. A chases visible wins, a raise, a bonus, or a trending investment tip. Each success is celebrated but does not feed the root system. It is consumed or displayed. B, on the other hand, invests in quiet, systematic growth, building skill stacks that can be monetized repeatedly, allocating small but consistent capital into compounding mechanisms, and creating optionality for future income streams. At first, A appears ahead. More visible rewards, more status, more applause. But over time, the invisible system that B has cultivated begins to dominate. Capital grows silently. Skills compound into leverage. Opportunities accumulate before anyone notices. The gap, once invisible, becomes unassailable. The key lies in structural mechanics, understanding how different financial components interact over time. There are three core pillars: capital flow control, directing money where it can reproduce quietly rather than evaporate; behavioral alignment, aligning daily habits, emotional triggers, and decision-making patterns to support long-term compounding; optionality architecture, creating multiple independent pathways for income that can grow simultaneously without constant attention. Each of these pillars is invisible until you intentionally structure them. They do not require luck, hype, or external approval. They require disciplined awareness of cause and effect, and the ability to operate in delayed reward timeframes. Here's the system-level truth. Most people fail because they confuse noise with signal. They chase rewards without understanding the infrastructure required to sustain them. They fixate on the immediate: salary increases, trending investments, social validation, while ignoring the underlying ecosystem of growth. And every time they do, they reinforce the cycle of visible anxiety, silent underperformance, and emotional fatigue. But now you're at the threshold of another realization. The system is not just passive. It responds to intelligent input. It amplifies small, well-directed actions exponentially. This is why seemingly tiny adjustments, shifting allocation by a few percent, automating recurring income streams, or stacking skill sets that can generate passive leverage, can create enormous structural impact. If these actions appear minor to outsiders, but are devastatingly effective when executed within a well-designed system. And there is a hidden layer most never see: your psychological alignment. The invisible financial architecture cannot function optimally if your identity, habits, and cognitive biases remain misaligned. Fear, impatience, status-seeking, and emotional reactivity are structural leaks. They siphon energy away from the system, reducing its compounding potential. Controlling these internal factors is not about willpower. It is about designing environments and triggers that channel behavior into productive patterns automatically. You're now facing a choice: continue chasing visible gains that evaporate, or step into a quieter, systemic approach that multiplies over time. This is the cognitive threshold few ever cross. To crossing it means viewing money not as a scoreboard, but as a flowing system. Every allocation, every decision, every emotional response is input into a complex architecture that responds predictably, but only if you understand the rules. And here is the quiet cliffhanger. This is only the first pillar. You've seen how structural architecture defines potential. Next, you will discover how behavioral traps, identity biases, and social illusions sabotage even the smartest people, often before they realize what hit them. The system is ready to respond, but first, you must navigate the human mind, which is often its own worst enemy. If Section 1 revealed the hidden architecture, this section exposes the silent saboteurs that erode it. The truth is stark. Most people are not destroyed by a lack of opportunity or knowledge. They are destroyed by themselves. Human psychology is exquisitely designed to sabotage long-term wealth accumulation. And it does so in ways that feel invisible, inevitable, and sometimes even justified. Consider the way status illusions govern behavior. You earn a modest bonus, yet feel compelled to upgrade your phone, buy a larger car, or post images that signal success to others. On the surface, these are harmless choices, even rewarding. But each act is a behavioral tax, a diversion of capital from silent systems into ephemeral signals. The emotional hit of keeping up is immediate, pleasurable, but ultimately corrosive. These micro-decisions, repeated over months and years, are the cracks through which compounding potential leaks. This is why people who appear intelligent, disciplined, or even financially educated often find themselves trapped in cycles of stagnation. The next trap is emotional spending. Money is a loaded stimulus. It triggers fear, pride, envy, and reward circuits all at once. Behavioral economists have shown that humans disproportionately favor immediate gratification, even when delayed rewards are exponentially more valuable. You've felt this. You see a deal, a temptation, a luxury item, and the emotional surge convinces you to act against your long-term interest. This is not weakness, it is biology. The system is exploiting instincts evolved for scarcity, not abundance. Without mechanisms to intercept these impulses, the invisible income streams you are building are silently sabotaged. Identity-based financial self-sabotage is subtler, yet more destructive. People construct self-narratives that govern how they use money. I am not the type of person who invests, or I need to show I've made it, or I deserve this now. These narratives act as internal architects, directing capital in ways that seem rational but are systematically misaligned with wealth-building principles. Even high earners can fall victim. A six-figure salary becomes invisible if it is continually absorbed by self-limiting identity constructs. Income is not just money. It is a reflection of who you think you are. And if your identity is misaligned with compounding systems, the best strategies will fail. Now, let's layer another system-level insight. Status anxiety and comparison amplify behavioral leaks. Social media, peer pressure, and cultural storytelling constantly broadcast benchmarks of success. Yet humans instinctively internalize these signals and attempt to replicate them, often prematurely, often inefficiently. Consider someone earning $80,000 annually who constantly measures themselves against peers earning $120,000 and living in higher-cost lifestyles. The invisible tax here is enormous. Every decision, buying a larger home, funding luxury experiences, over-leveraging credit, is a response to perceived social gaps rather than strategic compounding. The structural outcome is predictable: capital diversion, financial stress, and stagnation. Behavioral finance traps do not operate alone. They intersect with cognitive biases, hyperbolic discounting, overvaluing immediate rewards, and undervaluing delayed compounding. Anchoring bias, evaluating opportunities relative to arbitrary numbers or prior purchases. Loss aversion, overreacting to small setbacks, leading to risk-averse stagnation or overcompensatory decisions. Overconfidence illusion, believing that knowledge or skill alone can override systemic rules. Each bias creates microleaks in the financial ecosystem. Alone, they seem minor. Together, they can decimate silent income streams over time. But here is the structural insight few recognize. These psychological traps are not enemies. They are signals. Emotional spending, social comparison, identity misalignment, they reveal precisely where the system is misconfigured. The key is not to fight them with raw willpower, which is limited and unreliable. The key is to design systemic mitigations, automating capital allocation to bypass impulse, structuring optionality to absorb risk without emotional overreaction, rewriting internal narratives to align identity with compounding behavior rather than visible status. This is the intersection of human psychology and structural finance. It is why two people with identical income, intelligence, and opportunity can have radically different outcomes. One collapses under invisible psychological taxes. The other harnesses them into deliberate advantage. Here's a micro cliffhanger. Even if you understand these behavioral patterns and can design mitigations, there is another layer, a hidden mathematical structure, that will amplify or destroy everything. This is the stage where compounding velocity, thresholds of capital, and numeric leverage operate silently, independent of emotion. Most never reach it because the traps described above quietly bleed their potential before they even start. Next, you will see how mathematics, compounding, and threshold effects turn small structural advantages into unstoppable income engines. This is where invisible architecture meets systemic leverage, and it is where the quiet growth you've been preparing for begins to accelerate in ways outsiders cannot perceive. If Section 2 exposed the silent psychological saboteurs, this section reveals the hidden arithmetic that transforms quiet actions into unstoppable wealth. The paradox is striking. Small, seemingly insignificant inputs, when correctly structured, generate outcomes that appear miraculous, but only because most people never understand the underlying mathematics. This is the moment where invisible architecture meets tangible results, where patience, structure, and strategic allocation amplify exponentially. Compounding is not merely a concept, it is a force. Yet, most explanations are superficial. They focus on interest rates, simple returns, or vague invest early slogans. True compounding requires understanding three interdependent variables: rate, frequency, and structural leverage. Each is a lever that, when optimized, accelerates wealth far faster than linear thinking predicts. Consider this. If you invest $1,000 with a 10% annual return, it grows to roughly $2,593 over 10 years. Incrementally increase the rate by 2% or add $100 monthly, and suddenly the final amount balloons to over $5,000. The difference is not just arithmetic, it is structural. Small, disciplined inputs, repeated consistently within a compounding system, produce exponential growth. But here is the subtlety few notice. Compounding is threshold dependent. There exists a capital level at which growth suddenly accelerates. Below the threshold, gains are slow, linear, almost imperceptible. Above it, the system leverages scale, optionality, and reinvestment mechanisms to produce velocity that appears disproportionate to input. This is why early-stage income streams feel frustrating. They are quietly building roots beneath the surface. When the threshold is crossed, the system begins to feed itself, and growth becomes visible almost overnight. But it was never instantaneous. Let's model this structurally. Imagine three streams: Skill-based stream. You invest in a specialized skill that generates $500 per month initially. Over 2 years, with repeated application and skill stacking, it compounds to $2,500 per month. The growth is not merely additive. Mastery unlocks leverage. Clients pay more, the efficiency multiplies output, and reputation accelerates demand. Capital allocation stream. $10,000 allocated into a diversified set of low volatility, income-producing assets grows at 8% annually. Through compounding, reinvestment, and tactical redistribution, this single pool generates not just passive income, but the capital necessary to cross thresholds in other streams. Opportunity stream. Early identification of emerging markets, niches, or arbitrage opportunities creates asymmetric growth. Initial returns may seem negligible, $200 to $300 per month, but once integrated with skill and capital streams, these small inflows are magnified, producing exponential acceleration. The math is simple but unforgiving. Multiplicative interaction beats additive effort. Too often, people add streams linearly, expecting proportional results. In reality, the system is non-linear. Cross-leverage, timing, and integration create growth that dwarfs isolated efforts. The quiet architect recognizes this and structures income streams to interact. Here's where wealth velocity becomes critical. Velocity is the speed at which capital circulates, multiplies, and compounds within your system. You can have $100,000 invested, but if it sits idle, velocity is zero. Your system produces nothing beyond static interest. If you allocate that capital strategically, reinvested, leveraged where risk is asymmetrically favorable, and paired with skill and opportunity streams, velocity multiplies compounding, turning slow growth into exponential outcomes. This is why the wealthy rarely appear to be working harder. They have engineered velocity into the very fabric of their financial ecosystem. But there is a hidden variable that rarely gets mentioned: structural timing. Compounding does not act in isolation. The environment, interest rates, market cycles, regulatory shifts, and technological adoption interacts with your system. Those who understand timing exploit these forces quietly, allocating resources when the system is primed to accelerate. Miss the timing, and compounding stagnates. Catch it, and growth multiplies far beyond initial projections. Let's examine thresholds numerically. Consider a small, skill-based stream generating $500 per month, reinvested into micro-investments with a 10% yield. Year 1, $500 times 12 months equals $6,000. Reinvested with compounding. Year 2 equals $6,600. Year 3 equals $7,260. To most, this seems slow, but integrate optionality and cross-leverage. Allow those earnings to fund emerging niches. I reinvest into skill amplification, and suddenly, year 5 could exceed $20,000 per month. The system quietly scales before anyone notices because small inputs interact non-linearly with compounding, leverage, and optionality. Here is the micro cliffhanger. Even with math and thresholds understood, most fail because the system is not immune to psychology and environment. Behavioral traps, social pressure, and decision fatigue threaten velocity, leak capital, and destabilize streams. To harness compounding fully, you must now consider why intelligent people with access to perfect strategies still fail, and how lifestyle, programming, and environmental factors quietly erode potential. In the next section, we reveal the paradox. Even high IQ, disciplined individuals often sabotage invisible income streams, not out of ignorance. but because of the subtle influence of social and environmental programming. This is where structural awareness intersects with real-world execution, and where quiet growth can either flourish or collapse. If Section 3 exposed the mathematical engines behind quiet income growth, Section 4 confronts a harsh reality. Intelligence, talent, or skill alone do not guarantee financial success. In fact, some of the smartest people are the most vulnerable to invisible failure. This is not a flaw in intellect. It is a flaw in environmental and social programming. Consider this. You may know exactly how to allocate capital, stack skills, and structure streams for compounding. Yet, each day, you exist within a network of subtle pressures that influence your decisions without conscious awareness. Friends, family, colleagues, and cultural narratives silently set benchmarks, define acceptable lifestyles, and dictate the perception of success. If your income rises, so does your exposure to these pressures. A new raise prompts a larger apartment, a trendier car, and upgraded experiences, all of which may feel justified, yet systematically bleed capital from quiet income streams. This is lifestyle inflation, a subtle tax imposed by your environment. Even high IQ individuals fall prey because social programming is invisible. The mind interprets acceptance, status, and approval as critical outcomes. Spending decisions are rarely isolated. They are a response to social stimuli. Without deliberate frameworks, the human brain defaults to comparison, imitation, and signaling. These behaviors are biologically and culturally encoded. They feel automatic, natural, and unavoidable. Yet each choice slowly erodes compounding power. This is why many intelligent professionals earn six figures but remain financially stagnant. Their capital allocation is silently redirected toward maintaining social equilibrium rather than building invisible growth systems. Decision fatigue compounds the problem. Each day, you make dozens, sometimes hundreds, of small financial and lifestyle choices. Individually, they seem trivial. But psychologically, the cumulative effect depletes mental bandwidth, causing shortcuts, emotional purchases, or reactive behavior. Intelligent people often underestimate this drain because they overvalue conscious decision-making. In reality, even sophisticated plans crumble under the weight of unnoticed daily pressures. Financial systems demand consistency, yet human behavior is probabilistic. Without automated or structured mechanisms, environmental and emotional factors quietly sabotage long-term outcomes. Now let's layer another mechanism: social comparison illusions. Humans are wired to measure success against peers, neighbors, or digital representations of achievement. On social media, you see curated highlights, luxury cars, exotic trips, and high-status lifestyles. Your brain instinctively registers these as benchmarks. Even if you earn more than most peers, the perception of inadequacy triggers spending, signaling, and capital diversion. It is a psychological trap, invisible, relentless, and disproportionately damaging. The system punishes those who value appearance over structural leverage. Where here is a structural insight few realize: intelligent people fail because they overestimate control and underestimate environmental influence. They believe knowledge and skill alone produce outcomes. But every quiet income stream is embedded in a larger ecosystem of behavioral, social, and structural variables. The mathematics of compounding, from Section 3, can only operate optimally when psychology and environment are aligned. If your decisions are influenced by social pressure, status anxiety, or lifestyle inflation, compounding slows or stalls. Decision fatigue, environmental pressure, and subtle social programming are compounded further by information overload. Intelligent individuals often consume vast amounts of financial data, newsletters, courses, trends, and advice. This creates an illusion of control and sophistication, but it also fragments attention, generates analysis paralysis, and triggers reactive behavior. Instead of executing a quiet, consistent plan, capital and effort are constantly redirected into noise, derailing the system before thresholds for velocity and compounding are reached. But here is the paradox. These pressures are not insurmountable. Awareness alone is a structural lever. Once you recognize the invisible forces acting on your decisions, you can design preemptive interventions, automation, optionality buffers, identity alignment, and environment engineering. High IQ individuals who learn this paradoxically gain the greatest advantage. Their capacity for strategic thinking, when freed from social, emotional, and environmental friction, becomes a force multiplier for invisible income streams. And here is the micro cliffhanger. Even with environmental mastery, behavioral mitigation, and mathematical understanding, success requires a deliberate structural blueprint. Capital allocation, asset selection, skill stacking, and risk control must converge in a system that is robust, scalable, and resilient. Without a blueprint, invisible growth remains fragile, susceptible to shocks, mistakes, and human frailty. In the next section, we will build that blueprint, a strategic framework that turns theory into actionable structure, aligning capital, skill, and behavior into systems that quietly accelerate income streams beyond what most people ever imagine. The foundation is laid, the psychology navigated, the math understood. The next step is design. Everything we've explored so far, the invisible architecture, behavioral traps, compounding mechanics, and environmental pressures, leads to one inevitable truth. Without a strategic blueprint, potential remains unrealized. The blueprint is the skeletal system upon which silent income streams grow. It is not a static plan. It is a dynamic framework that integrates capital, skill, risk management, and optionality into a self-reinforcing engine. Those who master it operate quietly yet powerfully, building streams that eventually overwhelm superficial, noisy wealth. At the core of the blueprint are 5 pillars: capital structure, asset acquisition, skill stacking, cash flow architecture, and risk asymmetry. Each pillar functions independently, yet interacts multiplicatively. Neglect one, and the system falters. Optimize all 5, and growth becomes inevitable. Yet Pillar 1, capital structure. The first step is understanding how to allocate resources. Most people treat money as fungible. Every dollar is the same. But within a silent income system, every dollar has purpose, velocity potential, and thresholds of compounding. Capital is divided into discrete zones: operational liquidity, funds required for daily and short-term needs, insulated from risk; growth capital, allocations for high-velocity income streams, skill investment, and market opportunities; resilience reserve, emergency buffers and hedges designed to prevent behavioral or environmental disruptions from collapsing momentum. The key is proportional distribution, regularly reviewed and dynamically adjusted as thresholds for compounding and optionality are crossed. Misalignment here is the silent killer of income streams. Pillar 2, asset acquisition logic. Not all assets are equal. Some produce visible status but negligible compounding. Others silently reproduce capital. The blueprint distinguishes between consumptive, speculative, and productive assets. Productive assets generate repeatable, compounding returns, income, skill leverage, or equity in scalable systems. Each acquisition is evaluated against criteria. Compounding potential optionality created behavioral friction, how much it exposes you to emotional spending. Time horizon for threshold activation. This pillar ensures every dollar purchased or allocated feeds the silent system rather than draining it. Pillar 3. Skill stacking model skills are the invisible currency of compounding income. Unlike capital, skills have indefinite scalability when layered strategically. The blueprint focuses on stacking, combining complementary competencies to create exponential leverage. For instance, coding plus marketing plus business strategy equals a rare skill stack that can generate independent revenue streams or amplify investment returns. Each skill becomes an engine, feeding other pillars and producing optionality invisible to outsiders. Pillar 4. Cash flow architecture. Income without structure is wasted energy. Cash flow must be automated, allocated, and reinvested according to system rules. The blueprint separates inflows into recurring, semi-passive, and optional streams, each routed through compounding mechanisms. Automation here is crucial. It eliminates behavioral friction and protects against emotional diversion of capital. Small leaks, repeated over years, are catastrophic. So structured cash flow ensures velocity and thresholds are consistently met. Pillar 5. Risk mitigation and asymmetry. No system survives without robust risk management. The blueprint leverages asymmetrical risk, exposing small portions of capital to high upside opportunities while protecting core reserves. Leverage is controlled, optionality is embedded, and contingency structures are preemptively designed. This is the difference between growth that accelerates silently and growth that collapses under stress. Now consider the integration. Capital feeds assets. Assets generate cash flow. Cash flow supports skill stacking, and skill application enhances optionality. Each pillar is a gear. The system functions only when all gears turn together. The blueprint transforms theory into applied architecture, visible only to those who understand the design, yet powerful enough to generate streams that appear unstoppable from the outside. But there is a hidden mechanic: timing windows. Even perfect architecture fails if not executed in synchronization with opportunities, thresholds, and velocity triggers. Patience alone is insufficient. Awareness, observation, and responsiveness to subtle environmental cues ensure that streams activate when compounding is maximized. This is the bridge to acceleration. Here is the micro cliffhanger. The blueprint provides structure, but structure alone is not enough. To truly amplify wealth streams, you must engage the acceleration phase, a dual-engine system that simultaneously grows income and assets, leveraging optionality and timing for explosive, but quiet growth. Most never reach this stage because it requires disciplined patience and systemic trust in invisible forces. In the next section, we will reveal the acceleration phase, where architecture, compounding, and psychology converge to propel income streams far beyond ordinary expectations. If Section 5 revealed the strategic blueprint, Section 6 is where the engine ignites. The acceleration phase is the convergence point. Architecture, psychology, compounding, and timing fuse into a system that moves quietly yet irreversibly. Most people never reach this stage because it requires mastery of both self and structure, as well as the patience to let invisible mechanisms activate before expecting visible results. Acceleration relies on a dual-engine system, simultaneous growth of income streams and asset compounding. These engines are not merely parallel. They are mutually reinforcing. Income provides velocity and optionality. Assets generate capital amplification and thresholds for larger compounding. When coordinated, even modest inputs explode in output. Consider it like twin turbines in a submarine. One generates thrust, the other stabilizes, but together they allow silent, rapid movement that outsiders cannot perceive. Engine 1. Income amplification. Income is no longer just earned, it is strategically multiplied. The blueprint from Section 5 enables stacking. Recurring income from skill-based streams, semi-passive opportunities, and small asymmetric plays combine. Each stream is scaled according to potential leverage and optionality. The critical insight: income must not be consumed prematurely. Each dollar reinvested feeds thresholds, velocity, and compounding rather than status or transient satisfaction. Emotional restraint becomes structural leverage. Engine 2. Asset velocity. Assets, when properly structured, do more than store value. They reproduce it. In the acceleration phase, assets are allocated to exploit timing windows, asymmetrical risk, and strategic optionality. Real estate, equities, digital platforms, or small business ownership. Each is deployed not for short-term gains, but to activate compounding velocity within the system. Even small capital, if directed through correct channels, can trigger exponential returns when thresholds are crossed. Here is a critical principle: leverage control versus leverage abuse. Leverage is often misunderstood. Misapplied, it destroys silently and quickly, like a hidden structural crack in a skyscraper. Proper leverage amplifies velocity without compromising resilience. The system must maintain integrity. Core reserves, risk asymmetry, and optionality buffers ensure that growth does not collapse under pressure. Those who accelerate too aggressively without controls see. Invisible systems fail before visible rewards appear. Optionality is another defining factor. Each stream, each skill, each asset is deliberately chosen to generate multiple future pathways. Optionality allows the system to exploit emerging opportunities while preserving core compounding mechanisms. Without it, acceleration is linear. With it, growth is exponential and resilient, capable of absorbing shocks while still amplifying quietly. Timing is the hidden multiplier. Not all income and asset opportunities yield the same velocity if engaged at the wrong moment. The strategic windows, market cycles, skill maturation, behavioral readiness must be observed and acted upon. Acceleration is not about constant action. It is about orchestrated input into the system at peak leverage points. This is why the quiet architect always appears patient, deliberate, almost invisible, because the system is silently growing even when no overt activity is visible. Let's visualize. A skill-based income stream generates $2,500 per month. $10,000 of capital is allocated into high-yield but low-risk assets. Optionality allows both streams to interact. Income reinvested into assets, assets funding new skills producing new income. Over months, the system reaches velocity thresholds. The compounding effect of income, capital, and optionality creates a growth curve that appears explosive, but only to those observing from the outside. Inside, the system has merely followed design and timing rules. Acceleration also introduces feedback loops. Successful income streams fund skill development, which increases income potential. Asset gains create optionality that produces new income opportunities. Each feedback loop compounds the next. And because this occurs under a disciplined system of reinvestment, reserve protection, and behavioral alignment, The loops are self-reinforcing. The quiet architect watches growth accelerate, rarely needing to intervene directly. The system runs itself. But here is the micro cliffhanger. Even this engineered acceleration is only one half of the transformation. True silent wealth requires an internal evolution, a psychological alignment where delayed gratification, strategic detachment, and long-term identity reframing become permanent. Without this, velocity may be achieved temporarily, but growth will be sabotaged by internal impulses, emotional spending, or misaligned identity. The next section addresses this. Identity evolution, the stage where inner transformation locks in outer results. If Section 6 is the ignition of the engine, Section 7 is the transformation of the operator. Income streams, assets, and compounding mechanics are powerful. But without the internal evolution of identity, even the most perfectly engineered system can falter. The acceleration phase amplifies not just money, but psychological pressure. Without recalibration, old impulses, emotional habits, and identity misalignments can leak value and derail growth. Identity evolution is the quiet stage where internal architecture synchronizes with external structure. The first principle is delayed gratification rewiring. Society trains humans to seek instant reward, likes, recognition, purchases, and status. Yet invisible income streams require a horizon measured in years or decades. Identity evolution transforms your perception of time. Impulse becomes information. Desire becomes optionality. You begin to see each deferred reward not as sacrifice, but as structural amplification of future power. This shift is subtle but fundamental. It converts emotional friction into leverage. The act of restraint itself feeds compounding velocity. Next is strategic detachment. The evolved identity no longer measures worth by comparison, validation, or external applause. Where previously a raise or bonus might trigger status-driven spending, the evolved self recognizes the systemic role of every dollar. Money is not affirmation. It is energy to be directed toward compounding infrastructure. This detachment is not cold, it is intentional. It frees the operator from social programming, lifestyle inflation, and emotional hijacks. With detachment, the system can function at maximum efficiency, unimpeded by identity leaks. Another dimension is thinking in decades, not months. Early in the journey, gains and losses feel disproportionately large. The untrained mind interprets short-term fluctuations as signals to act, often counterproductively. Identity evolution introduces temporal scaling. Each decision is assessed relative to decade-long horizons. A $1,000 mistake in year 1 becomes negligible when mapped against a compounding trajectory of 10 years or more. Conversely, a strategic $1,000 allocation can amplify tenfold or more when viewed in the same frame. This long-term lens transforms emotional reactions into structural discipline. Skill and behavior alignment is equally crucial. Identity evolution is not purely cognitive. It is operational. Habits, routines, and reflexes are rewired to support the system rather than resist it. Micro decisions, when to invest, where to allocate energy, when to seize opportunities, become automatic, almost invisible. This frees conscious bandwidth for high-level strategy and observation, while the system runs quietly beneath. The evolved identity is both participant and architect, influencing input while allowing compounding and feedback loops to operate uninterrupted. Here is a subtle paradox. True identity evolution does not feel like struggle. The transformation is almost invisible externally, yet profoundly structural internally. Emotional tension cycles, fear, desire, envy, are not eliminated. but redirected. Fear becomes vigilance, desire becomes patience, envy becomes observation. Each cycle reinforces system integrity rather than undermining it. The internal evolution becomes a feedback loop that strengthens compounding, accelerates optionality, and protects against psychological sabotage. A second paradox emerges. The quieter the growth, the more identity is reinforced. Use external validation becomes unnecessary because the internal system generates its own metrics of progress. The evolved self experiences a deep sense of agency and control, quiet, cumulative, and unshakable. Visible results may lag, but the underlying momentum is irreversible. Those who have not reached this stage mistake early patience for inactivity, when in fact the system is quietly accelerating toward thresholds that will soon trigger visible breakthroughs. And yet, even this evolution is preparatory. It positions you for the final stage of transformation. Wealth redefinition. At this point, income, assets, and identity are synchronized, but society's traditional metrics of wealth, freedom, and power are still misleading. The next section will challenge assumptions, reveal hidden truths, and expand your understanding beyond money into the deeper structures of influence, autonomy, and agency. The cliffhanger is clear. Identity evolution alone does not produce maximum impact. It unlocks the system to operate fully. The next shift is conceptual, almost philosophical, yet deeply practical. Only when wealth, freedom, and power are redefined on structural terms does the system reach its ultimate potential. If Section 7 aligned identity with systems, Section 8 reorients the map itself. Traditional definitions of wealth, high income, expensive possessions, social recognition, are distractions. They are metrics designed to keep most people chasing visibility rather than compounding power. True silent growth demands a redefinition. Wealth is not what you earn. It is what you control, leverage, and allow to reproduce quietly. Freedom is not consumption. It is optionality. Power is not status. It is structural influence. First, consider wealth beyond income. Income is transient. It appears, fluctuates, and often disappears if your labor stops. Wealth, by contrast, is systemic, embedded in compounding structures, optionality, and resilience. It exists in skill stacks, income streams, reinvested capital, and threshold-crossing mechanisms. Wealth produces itself. The person who understands this can maintain growth even when income fluctuates or temporarily halts. Most individuals never see this distinction. They confuse the scoreboard of monthly paychecks with the engine of structural abundance. Next, freedom redefined. Society teaches freedom as consumption, vacations, cars, gadgets, or early retirement. But these are external signals, not internal leverage. Real freedom is embedded in choice architecture. It is the ability to direct time, attention, and capital without being enslaved to impulses, obligations, or social expectations. Optionality is the functional measure of freedom. The more avenues you have to generate income or redirect resources, the less you are constrained. This is why quiet income streams feel invisible. They operate independently, yet their presence expands freedom exponentially. Power, too, is often misread. Traditional power is public, social, and visible. In contrast, structural power is silent and accumulative. It emerges from the ability to deploy resources, skills, and networks strategically, creating influence and results without spectacle. Those who wield this form of power rarely announce it. It manifests in control over outcomes, velocity of action, and capacity to act when opportunities arise. Like the quiet accumulation of capital, This form of power grows unnoticed until thresholds are crossed and impact becomes apparent. To operationalize this redefinition, consider 3 structural behaviors. Invisible leverage allocation, directing capital and skill toward mechanisms that amplify themselves rather than signal to others. Optionality maintenance, designing systems so that every skill, asset, or streams can pivot, cross-leverage, and produce multiple future pathways. Resilience embedding, creating buffers against behavioral, environmental, and market disruption, ensuring compounding continues uninterrupted. Here's the hidden truth. When wealth, freedom, and power are understood structurally, the quiet systems from previous sections become self-reinforcing. Income streams accelerate, compounding amplifies, and identity evolution ensures decisions remain aligned. External validation, consumption-driven decisions, and status anxieties no longer divert energy. Growth is both inevitable and invisible until it reaches critical mass. Let's layer another insight. The world continues to mislead most people with loud wealth signals. Flashy purchases, social proof, and hyper-visible success create envy and distraction, drawing attention away from structural leverage. Meanwhile, those operating in silence continue building thresholds and velocity. By the time the world notices, the compounding is so advanced that catching up becomes virtually impossible for those still following traditional paradigms. But here is the micro cliffhanger. Understanding wealth, freedom, and power on structural terms sets the stage for the final phase, the challenge plus ascension close. This is where theory meets action, where identity, system, and strategy converge into a single, undeniable directive. Step into quiet, unstoppable growth, or remain trapped in visible yet fragile constructs. The next section will crystallize everything into a single challenge that transforms understanding into irreversible momentum. Everything you've absorbed, the invisible architecture, behavioral traps, compounding mechanics, social pressures, strategic blueprint, acceleration phase, identity evolution, and wealth redefinition, now converges into one decisive moment. The question is no longer theoretical. Will you step into the system, fully aligned, or remain a spectator, silently sabotaged by psychology, environment, and misplaced status? This is the crucible where knowledge becomes action, where potential solidifies into irreversible momentum. The challenge is simple but profound. Design, deploy, and defend your quiet income engines relentlessly. Treat every dollar, skill, and decision as a component of a larger, compounding system. Monitor velocity, respect thresholds, and maintain optionality. But above all, protect your identity alignment, your ability to defer, detach, and operate structurally. Any compromise here leaks exponential potential. The system only rewards those who commit fully, quietly, and consistently. Now, visualize your future self, not the one trapped by comparisons, impulse, or fleeting status, not the one scrambling for recognition or temporary gain. Visualize the person whose income streams multiply silently, whose capital flows through structured channels, whose skills produce leverage independent of attention, and whose identity is calibrated to operate on decade-long horizons. This self is unshakable, strategic, and quietly unstoppable. Every decision you make today either moves you toward that reality or away from it. Here is the strategic call. Begin immediately. Audit your capital allocation, assess behavioral leaks, map your skill stack, and define thresholds for compounding. Remove distractions that siphon energy, automate where possible, and embed buffers for resilience. Start with micro actions that align with the system rather than interrupt it. These small, deliberate acts, compounded over months and years, is create structural acceleration invisible to outsiders, but overwhelming in effect. Remember, the world measures wealth loudly: flashy cars, social approval, ostentatious purchases, but these signals are decoys. True growth is quiet, invisible, and accumulative. Those who master it appear calm, patient, almost inert, until the system reaches a tipping point and their power, freedom, and wealth explode. Not as a product of luck or noise, but as the natural outcome of disciplined structure. The final imperative is this: operate in silence, build relentlessly, and trust the invisible system. Every choice, every act of patience, every disciplined allocation compounds quietly, invisibly, and with unstoppable force. The moment you embrace this, you step beyond the crowd. You leave behind the traps of visibility, status, and instant gratification. Won't you become the architect of streams that generate themselves, thresholds that multiply automatically, and velocity that accelerates without notice? And the unforgettable closing line: quietly, deliberately, invisibly, build the streams that leave the world wondering how you became unstoppable while everyone else was still chasing applause.